Your Excellency, Bola Ahmed Tinubu, GCFR, President of the Federal Republic of Nigeria, Your Excellencies, Executive Governors of several states of the Federal Republic of Nigeria, Honorable Ministers, Ambassadors, and heads of international agencies, captains of industry, distinguished guests, members of the press, ladies and gentlemen. Please allow me to stand on established protocols due to time constraints. Please accept my sincere regrets for not being able to be with you in person due to circumstances beyond my control. It is my great honor to speak to you at this important international conference on working towards a just energy transition and attracting investments in Africa. The subject of just energy transitions, which means the process of finding energy pathways that are technologically adequate, cost-optimal, economically viable, and environmentally sustainable over time, has been at the center of development discourse globally during the past decade. Achieving this policy goal will lead to achievement of the inclusive growth agenda, one that triangulates the three pillars of sustainable development: the economic, the social, and the environmental. Your Excellencies, distinguished guests, ladies and gentlemen, today I am pleased to speak to you specifically on this important subject, focusing on the economic outlook of Africa and the opportunities within the green economy. I will focus my speech in four interrelated parts. First, I will provide a bird's-eye view on Africa's economic performance and outlook, unpack what a just energy transition means for Africa's economic growth, and examine Africa's opportunities within the fast-evolving green technology markets and global green growth transition, and make some policy recommendations for your consideration. These topics were examined in depth in the African Development Bank Group's African Economic Outlook Reports, Regional Economic Outlook Reports, and Country-Focused Reports for the years 2022 and 2023. I encourage you, therefore, to please read these reports for more insights on the global, continental, regional, and national policy imperatives of climate resilience and just energy transitions, and the global green growth policies for your specific region and country. Time constraints will not allow me to provide in-depth details in this speech. While the fast-evolving climate-smart and low-carbon technologies and markets provide significant opportunities for accelerating the sustainable development goals in countries, individual countries' responses and response policies shape the winners and losers in the green transition markets. It is therefore of critical importance that each country engage proactively to enact evidence-based policies that optimize the social, economic, and environmental benefits of green transition based on their own contexts. Now, let me provide a bird's-eye view on Africa's economic performance and outlook. Despite the overlapping impacts of weakened global growth, the effects of tightening global financial conditions on consumer price inflation, exchange rate volatility, weak external demand, and increased debt vulnerabilities, the structural challenges in global trade architecture caused by COVID-19 pandemic, the increased geopolitical and regional conflicts, and growing impacts of climate change, African economies have shown remarkable resilience. Real GDP grew by 3.8% in 2022, more than 2.9% recorded in 2019 before the COVID-19 pandemic, and higher than the world average of 3.5% in the same year. The continent was the second fastest growing economy globally after Asia, which grew by 4.2%. Out of the 54 African countries, 52 expanded in 2022, with 18 recording growth rates above 5%, consolidating the recovery and gains from the pandemic recorded during the previous year. Africa's average growth is projected to stabilize at about 4% in 2023 and 2024, and 22 African countries are expected to record growth rates above 5% in 2024. 5 of the 6 pre-pandemic top-performing economies in Africa are projected to be back in the league of the world's 10 fastest-growing economies in the world in 2023 and 2024. However, amid this positive outlook, this rate of growth is not sufficient to create quality jobs and/or lift millions of Africans out of poverty, as weak institutions, subdued private consumption and investment, and low industrial sector performance continues to constrain economic diversification and structural transformation in Africa. In addition, the average growth performance and outlook are heterogeneous across different regions and countries and economic groupings in Africa. Closer home in West Africa, growth is projected to rise moderately to 3.9% in 2023 from 3.8% in 2022. This favorable outlook reflects higher growth in the region's small economies, 8 of which are projected to grow at 5% or more in 2023. In Nigeria, where we stay, Nigeria's growth decelerated to 3.3% in 2022 from 3.6% in 2021, largely due to weak global growth and fall in oil prices. But buoyed by agriculture and the service sectors, the country's growth is projected to remain around 3.4% and 3.2% in 2023 and 2024, respectively. However, depreciation of the naira and the inflationary pressures associated with the recent removal of fuel subsidies and deregulation of the forex market could dampen the outlook in the short run. In terms of economic characteristics, non-resource intensive economies, which are largely countries with more diversified economic structures, have constantly performed better in absorbing external shocks, while the reverse is the case for resource-intensive economies. Despite these broad-based positive outlooks, significant challenges and risks remain. Subdued global growth, high inflation fueled by rising food and energy prices and weakening domestic currencies, weak external demand, and high debt vulnerabilities exacerbated by the tightening global financial conditions, heightened risk premium due to information asymmetries and risk perception, increased physical risks of climate change, and the transition risks associated with climate policy, commodity dependence, and price volatilities in the commodity markets continues to constrain Africa's ability to harness its rich endowments in natural capital for inclusive growth. And increased geopolitical tensions and conflicts continues to impact on Africa's long-term growth prospects as significant resources are diverted to security expenditure. Of particular concern is the rising inflation, projected to increase from 14.2% in 2022 to a record 15.1% in 2023, before moderating to about 9.5% in 2024. This is mainly due to rising food and energy prices and the effects of monetary policy tightening and rising interest rates, and in some countries, domestic policies that have fueled the uptick in inflation. In Nigeria, for example, inflation reached an 18-year high of 26.7% in September 2023 from 20.7% in September 2022. Food price inflation remained elevated at 30.6% in September 2023 compared to 3.3% in September 2022. resulting from the impacts of fuel subsidy removal and rapid exchange rate depreciation. This is projected to remain high before moderating in 2024 if the right accompanying fiscal policies are implemented. Furthermore, debt vulnerabilities has continued to worsen due to rapid exchange rate depreciation, high primary deficits, and tightening global financial conditions. The median public debt in Africa is estimated at 65% of GDP in 2022, which is higher than the pre-pandemic level of 61% of GDP, and this is expected to increase further to 66% in 2023 before stabilizing at 65% in 2024. In Nigeria, public debt remains lower than the West Africa's average at 41.2% of GDP as of June 2023, but debt service to revenue is very high at 98.7% due to weak domestic currencies. Your Excellencies, distinguished guests, ladies and gentlemen, let me now turn to Africa's opportunities in the green transition markets. To unpack what this means for Africa, let me provide some stylized facts. About 85% of the global carbon budget is already used up, most of it by developed countries. Africa's historical share of global emissions is below 3%, with an average carbon footprint per capita of 0.95 tons of CO2 equivalent, well below the 2.0 tons of CO2 equivalent required to achieve the target for net zero transition. Compared to North America and Europe, where the average carbon footprint per capita is up to 14 tons of CO2 per capita and 7 tons of CO2 equivalent per capita respectively, Africa still has significant carbon headroom to grow its economies while remaining below the global carbon budget. But the continent is the least resilient region of the world. It also ranks least globally in climate readiness. Consequently, it bears a disproportionate burden of climate change impacts. Africa is already losing 5 to 15% of its GDP per capita growth annually due to climate change. In Nigeria, over 11.4% of annual GDP per capita growth is lost due to climate change. This is an addition to an increasing mortality, climate-induced conflicts, human displacements, and migration, among other climate impacts observed every day. Your Excellencies, distinguished guests, ladies and gentlemen, the above facts already frame the concepts of historical, distributive, moral, and economic justice that should underpin just energy transition in Africa. Africa cannot develop without access to affordable, reliable, sustainable, and modern energy services for all its citizens. To be pragmatic, just energy transitions should indeed be a transition, moving from current to a desired future, not an automatic switch in energy technologies. Historical evidence shows that energy transitions evolves gradually over time, often several decades, defined by technologies, market incentives, policy shifts, and consumer behavior. It does not happen spontaneously or serendipitously. Natural gas has served as a transition fuel in most regions of the world that has access to it, allowing countries to gradually reduce coal in the energy mix cost-effectively. Renewable energy technologies are still evolving, offering mostly intermittent supply that can, at best, supplement existing base load in the energy mix to gradually decouple energy use from CO2 emissions. African countries have significantly embraced renewable energy technologies during the past decade, with new investments in fossil fuel-based energy technologies declining significantly, but lack of affordable finance limit the pace of renewable energy rollout in Africa. For a just transition, therefore, Africa should massively leverage its natural gas resources as part of its energy mix, while investing in renewable energy value chains during the transition period. Just energy transition requires a common but differentiated responsibility for climate finance flows to climate-vulnerable countries, most of which are in Africa. To implement the revised nationally determined contributions (NDCs) submitted by African countries between 2.6 to 2.8 trillion US dollars are needed cumulatively over the years 2020 to 2030. This translates to about 242.2 billion US dollars per year on average. However, Africa received only 29.5 billion US dollars in 2019/2020. This is about 8 times less than the total required to implement the NDCs. West Africa region needs about 36.3 billion US dollars per year and received only 7.9 billion, leaving a financing gap of about 28.5 billion US dollars. Closer home, Nigeria, on the other hand, needs about 22.5 billion US dollars per year to implement its NDCs, but it received only 2 billion US dollars, leaving financing gap of about 20.5 billion US dollars. Ladies and gentlemen, just energy transition therefore requires that Africa continues to harness opportunities in the fast-expanding global green growth technologies and green markets. But the structure, flow, and scale of the current climate finance architecture mirrors the global finance architecture, making it very difficult for most African countries to effectively harness climate resilience opportunities in the financing schemes available. And while the buzzwords in the current climate finance discourse center around the promises of innovative financing instruments and the need for leveraging the private sector, our AEO 2022 report shows that empirical evidence shows sobering results. Private climate finance in Africa averaged only about 14% of the total by the year 2020, compared to 42% in other developing regions. And for every dollar of public finance, African countries were able to leverage only 0.16 cents in private finance, again, the lowest of all regions of the world. In comparison, the leverage ratio is about 18.5% in North America and 0.5% in South Asia and Latin America. Like in other aspects of development financing, several market barriers limit participation of the private sector in financing climate and just energy transitions in Africa, as significant information asymmetries and knowledge gaps about Africa drives high perceptions of risks and unfavorable risk-return profiles of climate and green growth projects in Africa. So, instead of targeting the more vulnerable and less resilient countries, climate finance is flowing more to less vulnerable and more resilient countries, further disadvantaging climate vulnerable countries, most of which are in Africa. Your Excellencies, distinguished guests, ladies and gentlemen, let me now turn to Africa's specific opportunities in the green transition markets. Africa is home to about 1.42 billion people, about 17% of the global population, hosts over 60% of the remaining arable land in the world, over 30% of the world's deposits of green minerals, and over 45% of global renewable energy technical potential, the highest in the world. Africa also hosts more than 5,000 billion cubic meters of natural gas resources just found, and most of the highly vulnerable countries to climate change in the world. With over 45% of global technical potential in renewable energy, the highest in the world, Africa is the best continent for renewable energy manufacturing and deployment. Africa's total renewable energy market size is estimated at $1.03 trillion by 2030. According to the International Energy Agency, tapping into Africa's underdeveloped gas reserves could add 90 billion cubic meters of gas per year by 2030, and this will increase Africa's share of global emissions by just 0.5% only. Africa's climate-smart agriculture and agribusiness are expected to reach a market size of about $1 trillion by 2030. And Africa's ICT market is expected to grow exponentially from $95.4 billion in 2020 to much more as digitization takes roots in the green transition markets. Africa has the resource potential to lead the electric vehicles technology revolution. More than half of African countries have at least one of the critical metals, such as lithium, cobalt, nickel, manganese, graphite, iron, or phosphate, needed to produce lithium-ion batteries used in electric vehicles and electricity storage that are essential for building the global green economy of the future. The reported discovery of over 3,000 lithium pegmatite bodies across Nigeria with grades comparable to leading global producers presents opportunities for Nigeria's competitiveness in the green technology markets. There are also significant opportunities for innovative green finance, which are not yet duly leveraged in Africa. These include social bonds, green bonds and loans, sustainability bonds and sustainability-linked bonds and loans, carbon pricing, carbon markets, debt for climate swaps, and blended finance. But Africa's participation in these innovative green finance markets have not been encouraging. The continent has been able to access only 2.5% and 1.7% of the world's total green loans and social bonds, respectively, and less than 0.5% of other types of green finance. Of the $2.2 trillion of green bonds issued globally between 2006 and 2022, Africa accounted for only about 0.2%. The lowest among the world regions. Of the global voluntary carbon markets valued at $2 billion as at 2021, Africa's share was only 6.2%. But Africa accounted for 41% of blended finance between 2016 and 2021, the highest globally, followed only by Latin America, which had a share of 28%. Among demand-side barriers to green growth investments in Africa are lack of implementable strategies and implementation effectiveness in countries, weak regulatory structures and institutions, lack of investment-ready projects, pipelines, and limited access to international markets. Among the supply-side barriers are limited experience of African markets and performance by international investors, information asymmetry, perceived high investment risks leading to high cost of capital and required rate of return, and poor credit ratings driven by the above barriers. A 2020 study by Moody's Analytics showed that with a 1.9% default rate, Africa is the least defaulter compared to other regions with regard to long-term infrastructure investments. This figure stands at stark contrast to East Europe, which is 12.4%, Latin America at 10.1%, North America at 6.6%, Asia at 4.6%, and Western Europe at 4.6% respectively. Therefore, a recent study by UNDP indicated that African countries could save nearly $74.5 billion in excess interest if credit ratings were based on more objective assessments of risks. Excellencies, distinguished guests, ladies and gentlemen, let me now turn to a few policy recommendations and key actions that different stakeholders could take to accelerate investments in climate and green growth in Africa. First, countries should establish clear and well-costed national development plans for climate and green transitions, considering their own development realities. Second, countries should implement fiscal incentives, including smart subsidies, to encourage climate-smart and green industries, spur growth, and raise demand, profitability, and sustainability. Third, multilateral and bilateral financial institutions should provide more risk-agnostic instruments, including guarantees at scale, to help de-risk investments by private sector in climate-smart and green projects in Africa. Fourth, multilateral and other development finance institutions should provide more concessional finance and grants to support countries to develop pipelines of bankable climate-smart and green projects with a high risk-adjusted rates of return to the private sector. And fifth, investments in capacities for green value chain development should be rapidly scaled up as countries implement policies to mobilize private sector resources for green infrastructure development in countries in Africa. Excellencies, distinguished guests, ladies and gentlemen, let us all stand together to leverage Africa's green potentials to accelerate climate-smart and green growth in Africa, without which the Global Sustainable Development Goals and Agenda 2063 will not be achieved. Thank you. Ndewonu, Ndibai.